Welcome to the Planet MicroCap Podcast, the #1 destination for everything microcap investing. I'm your host, Robert Kraft, and each week I sit down with elite investors, CEOs, and market experts to uncover actionable insights and real-world lessons you can apply immediately. Are you a new or experienced microcap investor? Do you want to meet microcap management teams as well as other microcap investors from around the world? Planet MicroCap hosts the highest quality in-person microcap events in North America. The mission is to bring the best microcap investors, companies, and allocators together to gather, connect, and grow. Visit planetmicrocap.com to learn more about our Las Vegas and Toronto events. Now, a quick disclaimer. This presentation is for informational purposes only and should not be construed as a recommendation to purchase or sell any security referenced herein. Planet MicroCap Holdings LLC and MicroCap Club LLC are not licensed brokers nor registered investment advisors. We, our partners, contractors, members, subscribers, guests, or affiliates may or may not hold positions in one or more of the securities mentioned in this presentation and may trade in such securities at any time. We may have received cash compensation from one or more participants for presenting at past, present, or future events. We recommend you consult a licensed investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this presentation. In this episode of the Planet MicroCap Podcast, we dive into the Diamond Hill Microcap strategy with Aaron Monroe, Tyler Ventura, and John Loesch to break down how they're finding alpha in one of the most underfollowed parts of the market. With a concentrated long-term approach and a 3 heads are better than 1 framework, they focus on simple, durable businesses with strong balance sheets and aligned management. We dig into why illiquidity and lack of coverage are features, not bugs, in microcaps, how they build positions through their graduation model, and why boring but beautiful companies can quietly compound capital over time. We mentioned several companies and sectors during this conversation, and I'm not a shareholder in any of them. Thank you again for tuning in to the Planet MicroCap Podcast, and please enjoy my conversation with Aaron Monroe, Tyler Ventura, and John Loesch. Guys, thank you for joining me today. How are you doing?
Great.
I don't know what I've done to, get the honor of having all 3 of the strategists here from the Diamond Hill Microcap team, but far be it from me. I'm very thankful. So, how's everything going? I mean, one by one, what's the latest? There, I'll go in my thing. I'll go clockwise. So, John, you go first, and then Aaron, and then Tyler.
So I'm good. I'm in the thick of it. I got a kid who's getting ready to go to college. So we're in college app season now. So I've been busy with all that lately, but it's all good. It'll be coming to a head here shortly.
Oh, you're applying for college? I mean, look, how accomplished are you? You joined the Diamond Hill Microcap team and you're applying for, I mean, wow, kudos to you. Aaron, how's it going, man?
Good, day by day, living the volatility of lovely microcap land, loving every minute. John mentioned we got kids, so a couple middle schoolers, which is keeping myself and my wife very busy, but life's good.
Oh, love it, man. Tyler?
It's kind of funny since we're on the kid topic as you kind of go in order. I had kids later, so I have a almost 5 and an almost 3-year-old now. So I get to learn all the parenting lessons from them and try to apply them to my little nuggets that are, running around everywhere.
You know what I've been doing?
You do have all 3 of us because we run the strategy with a 3 heads are better than 1 mindset. And so that's really how we operate and how we like to do it. So we're happy to be on the podcast together with you, man.
Absolutely. I mean, look, I should start a family podcast at some point, I've been doing this now for 10 years and all of my constituents, we all are like, oh, how old are your kids now? I'm like 6, 4, and 1, so look, we've actually, I've been following Diamond Hill for a long time, knowing the firm, all the different strategy and whatnot. So I wanted to kind of start off with, what sparked your passion for investing for all 3 of you, and then what landed you in microcap. So I'm going to go counterclockwise now. So Tyler, you first.
Yeah, I mean, for me, getting started investing, I was one of those who got into it at a very young age. I mean, for me, it was an outcropping of my love for baseball statistics and baseball cards, and kind of collecting as a kid. Now I'm probably a little bit older than you, so it was kind of pre-internet, and you had a lot of these pricing inefficiencies and trading and getting prices from magazines and things like that. And one of the lessons I got from my dad then was like, you can't make money owning 1 card. You need 50 of those rookie cards to really make any money, which is, why I have 50 worthless Mark McGwire rookie cards right now. But look, by the time I got into high school and got a job and started making my own money, I think, my parents kind of wanted a more productive outlet for me. and the internet started firing up. You had the Netscape IPO and the internet bubble. And fortunately, my parents, who are not, they don't work in finance or anything like that, but they kind of got some advice and got me a couple books, one Peter Lynch book and a Warren Buffett book. And I kind of went down those rabbit holes and really kind of learned the difference about being a trader versus an investor. And for me, that was, the light bulb went off and really clicked. And I was able to start investing with my own money because, the trading was getting kind of democratized back then. You were going from expensive full service brokers to like the Charles Schwab platforms. So I was able to learn and invest and trade on my own and make money and get through college that way. And that's kind of what started my passion for it. And I knew that this is definitely where I want to spend my career. There's nothing better than being an investor, as a profession. So that's kind of how I got started and got the bug.
The detail he left out is that he still has some of the Paine-Webber trading statements from back in the day that he recently shared with us.
That's awesome. That's so good. I was gonna say, like, you know what? I don't know. I'm not gonna ask any ages, but I was still one of those that opened up the New York Post every day, looked at the baseball scores, cut out the scores, put it in the notebook. So I very much vibe with that background for sure. So, Aaron, what was your origin, your investor origin story?
Yeah. So, for me, I guess investing in general really dovetailed really well with my upbringing. I had a very frugal upbringing. I very vividly recall, going grocery shopping with my mom, and you'd have the butter at the end of the aisle that's on sale, and it's stocked out, so you have to collect the rain check to go back. And so it was just for me, the concept of getting more than what you pay for really resonated. And when I was in college, I was working my way through the Intelligent Investor and actually happened to see Diamond Hill do a presentation on the Graham and Dodd Super Investor and paper. And it just clicked. It's like it made sense. There was no other way to kind of invest. And for me, I had some uncles that ran family business. And so the concept of business ownership really resonated with me, which for me is why small and microcap investing really was where I found the passion to invest, because I feel like those companies are so relatable, very tangible. You can get your arms around them. You can really talk to the people. Like, to me, businesses are very much living entities. You have people that are operating within them, trying to create value for society. And so they earn an existence every day. And the idea to get to participate as a capital provider for them, it just feels like a privilege.
Oh, amen to all of that. All right, John, your investor origin story.
Yeah, so mine, I'm a little bit later to the party than these guys were, in the sense that out of undergrad, I started on the distribution side of the business and very quickly realized I did not want to be on the distribution side of the business. It was the investing side that I found really fascinating. And that's when I started diving into the books, reading all the value investing stuff, and caught the bug, kind of like Aaron said, like, it's one of those things that either resonates with you or it doesn't. And for me, it was kind of like, I see no other way to invest. It just made intuitive sense to me. And I also started the CFA program at that time. And like a lot of things in life, there's some luck involved, because at the same time as right when Diamond Hill was deciding to build out their research group, and I got introduced through a friend who knew somebody at the firm and started the conversation. And sort of the rest is history, how I ended up here. And I think I was number 5 or 6 on the research team back in the day.
Heck yeah. All right, cool. So now that you guys all found each other, with our powers combined, the 3-headed monster that is Diamond Hill MicroCap team, you guys are known for intrinsic value discipline and long-term investment horizon. So how does that philosophy specifically translate when you're operating in the microcap universe, where volatility, liquidity constraints, and information gaps are much more pronounced? So I'll leave it to you two. Who wants to go first on that?
Yeah, I'll take that one. So I think applying that investment philosophy to microcap almost feels like a more pure version of investing. When you go up the market cap spectrum, and you have investors that are, literally physically moving their operations closer to the exchanges so they can shave 1/100 of a second off their trading. I mean, that couldn't be further from what we're trying to do as as investors. And, I sort of envision it as, what it must have been like for Buffett back in the 50s and 60s when he was running his investment partnerships, where those who were willing to do the research and really understand the businesses, and dig in with that long-term investment horizon, could generate outsized returns for their investors. And so that's what kind of microcap feels like to me in the modern investment landscape. And, those things you mentioned of liquidity constraints, to us, that's an advantage, because if it's liquidity constrained, you can't prudently run a multi-billion-dollar microcap strategy. And so for us, that means fewer institutional investors, which means less competition for us. So that's attractive. And then microcaps are also underfollowed by the sell side, which I think is important. You mentioned the information gaps. It's not uncommon to look up one of these microcap companies and see they literally have zero sell side coverage, which is something that often gets us very excited. And I think that problem has actually been getting worse as you've seen, research budgets on Wall Street getting squeezed over the last few years. I think that just, is another thing that kind of errs to our advantage over time. And then there's also less anchoring on consensus. How do you have consensus if you have 0 or 1 analyst, maybe covering your stock? You can't really have too much anchored on a consensus estimate. And then I guess lastly, I'd just say on the volatility piece, we view risk as the permanent loss of capital. And so, volatility to us creates more opportunities. I will say, when we started this, we sort of came in with the mindset knowing that it's going to be more volatile than, what we were used to up the cap spectrum. It has been that and then some. But thankfully, I started my career as a bank analyst here at Diamond Hill during the depths of the financial crisis. So I developed a little bit of an iron stomach for volatility. So that's served us well in the last few years. But I think overall, we're happy to go where other institutional investors are, either unable or unwilling to go if we can deliver value for clients.
So, John, quick follow-up. Is there anything too illiquid for you guys? If it hits all the other boxes, is there anything that's too illiquid?
Yeah, I mean, I'm not a big fan of absolutes. But yes, there is some threshold, and we would know it when we see it, as the famous line goes.
Fair enough. Aaron, Tyler, I was going to say, anything you want to add to philosophy and whatnot?
I think he covered it real well. Like we discuss this stuff all the time, so we walk in step.
Very cool. Yeah, no, I see. I ask about not necessarily absolutes, but sometimes, you get companies that'll be like, oh yeah, we had a conversation with that fund and they say that they told us that we were too, we weren't liquid enough or something like that. And, I'm sure that's the case in some respects, but I also like telling them sometimes like, that might also be them telling you that's them being nice, we'll leave it at that. So the next question I have for you guys then is, microcaps are often described as the most inefficient segment of the public markets. Stop me if I sound like a broken record on the podcast saying that here, but those inefficiencies, continue to persist year after year. So from your perspective, how and where do you think Diamond Hill has the greatest edge in exploiting some of these?
That's I think you hit the nail on the head. I mean, when you kind of look at that structural gap in the marketplace, and it seems to be kind of growing and widening. And I think John touched on some of these issues around capacity constraints and institutions kind of unwilling and unable to act in certain areas of the market, and sort of the sell side dynamics and career risk and asset gathering. I mean, I think if you step back and you look at some of the big picture of why we think a lot of these trends are going to persist. I mean, look, it's a mega cap world, right? I mean, when you look at, how many multi-trillion-dollar individual companies have multi-trillion-dollar market caps now? I mean, that would have sounded crazy 15 years ago when I started at Diamond Hill. And
it still sounds crazy.
It is. I mean, they show on TV and, in the press all the time, the percentage of market cap that the mega caps keep taking up of the indices. And then the passive flows kind of feed that beast, right? You have an increasing amount of passive flows kind of, taking up more of the bandwidth. And then the plethora of passive, inexpensive passive products. And you need billions and billions of dollars and trillions of market cap to be able to play that game. And one of the aspects of sell side coverage, I mean, clearly like small and micro get less resources allocated, as John mentioned. And one of the outcroppings of that is that there aren't all those estimates feeding that machine. I mean, so much of Wall Street and so much of investing has become that short-term consensus estimate game that gets played every single quarter, right? And so we think long-term and want to think through that. But when you don't have those estimates populating, it gets harder for those companies to kind of get into indices and get into the liquidity flows. So some of that stuff's pretty structural. I mean, and when you look at, the dozen or couple dozen companies that dominate the market cap world, and you have these, 1,300 companies under $1 billion in market cap, and collectively their market cap's probably as big as like Apple, like one stock in there.
And that's just in the U.S., Canada.
And that's just in the U.S. too, which that we predominantly right now are U.S. But I mean, it's amazing that, we still think that in order to operate in that world over here with the 1,200 or so companies, I mean, you really have to be turning over rocks, doing the hard work, and it's just going to reward people like us who have a passion for wanting to do that and who love doing that. So it doesn't seem like that, those dynamics are really going to change. Although at some point you kind of wonder, like, where does this passive machine kind of end? But that's probably a topic for another podcast.
Yeah, I was gonna say that one. I don't know if we have enough time to cover that bag of worms. Nor are we or the oracles here to figure out when that will end for sure. Or maybe, who knows? There's a few folks out there. There's some small microcap ETFs trying to flow.
Mm-hmm. Yeah, there are.
They're trying, but
there's some interesting ones kind of doing some multi-manager, because they're, when you're dealing with bigger pools of money, I mean, they're trying to figure out liquidity, and like everybody is, right? And so there's some interesting ways they try to do it with kind of multi-manager setups and stuff like that, sell or buy and stuff. So
I can't tell you how many conversations we had, like, oh, we should do an ETF, like, even in Planet MicroCap ETF. I don't know. I'm like, spell ETF for me. I don't know, like, how, not that I don't know what it is, but like what, especially a microcap, like, how am I gonna freaking do this, man? Like, I don't know. It's a problem for much smarter people than me to try. I mean,
having daily flows like that and not being able to kind of control capacity is pretty much one of the biggest barriers in that regard. So.
Guys like that. How do you spell ETF? That's fine. That sounds like my dad's joke. That's a good one.
It's a good dad joke.
That's the song. I got 3. I got better have a few of these dad jokes under my sleeve. So next question for you guys is, in some of your published commentaries, you often highlight businesses trading at discounts due to temporary challenges or misunderstood fundamentals. Where are the most common situations where you're seeing the market get microcaps absolutely wrong? Again, this might be like a 3-hour answer. So, but we'll do our best to stay.
I'll hit that from a couple different angles. I think one, you obviously can have temporary business challenges. Somebody could whiff on a quarter versus what people are thinking. You can have, losing a key client, which for smaller companies, that can be more impactful, where somebody's, 30% of your revenue and whatever, you lose a contract, that can be impactful. You could have kind of up and down the supply chain stream. You could have excess inventory in the channel. That's something that a lot of microcaps that we look at, got hit with coming out of COVID in particular. So these situations, create opportunities for long-term investors who can look beyond, 1, 2, 3 quarters. I think you have some different technical issues that can cause problems for small microcap companies where, a large holder becomes a forced seller for something that has nothing to do with the business, whether they're getting redemptions or whatever, or your stock gets booted from an index. All those sorts of things can have an outsized impact on small and microcap companies. But I think in terms of general misunderstanding, if we zoom back to kind of the 10,000-foot view, I think things that have pleasantly surprised us would be the companies that have like real durable moats or competitive advantages. In microcap, we found more of those, I guess, maybe than we would expect. Higher quality businesses. one example that we have owned in microcap and own elsewhere at the firm is UFP Technologies. Very successful investment for us. They play a key role in robotic surgery and packaging for orthopedic implants, those sorts of things. Detailed knowledge of material science. Not just some commodity widget company that, like, you think about, kind of small microcap companies not being high quality. UFP would be the counter to that. Another example would be kind of the quality of management. I think has been pleasantly surprising the longer we've done this, and finding some really, really good operators. Whether it's a second or third generation, family operator who really cares about the business because, their family name is on the door. If I were to think about like Ashley Smith at Smith Midland, who's I think a third generation CEO, that's a company that we've owned in the portfolio. We don't at the moment, but we have owned. Cares a lot about that business. His grandfather started. That means a lot. Another example would be where you have, a large, somebody who comes from a large organization with great experience coming down to a smaller microcap company. I think of Adam Michaels at Mama's Creations, which is a current portfolio holding of ours. Had a great successful career at Mondelez and came down to Mama's to transform that business. And the fun fact is we learned about that business on the Planet MicroCap podcast. Was actually the first time we learned about that business. I was traveling for work on an airplane. I remember sending a message to these guys as soon as I heard that interview. So great job on that one. And then the last one, I think people, I think they underestimate the flywheel when these things get going, and like when the business really gets escape velocity. And so there could be this progression of like, earlier I mentioned zero sell side coverage, or maybe one analyst that covers your stock. All of a sudden you get a little bit of a flywheel going, and you go from 1 to 4 or 5, and then that gets you to kind of the premier industry conferences, and you get more institutional eyeballs on your stock. And all of a sudden that can create this, this virtuous effect for the business and the shares of your company. Centrus Energy is another example I think of along those lines. When we first looked at Centrus back in 2023, I think they had 2 sell-side analysts. And I think people at our firm and my family, to be candid, thought I was insane with how excited I was about nuclear energy at the time. But you fast forward to 2026, and I think they have over a dozen sell-side firms now, all the bulge brackets. They're doing some, nuclear energy symposium next week with Goldman Sachs. So, I mean, this process of discovery, really does take time, and you need to be patient with it. So I think those would kind of be the things I'd highlight about kind of misunderstandings about the microcap space.
Man, I was going to ask you some examples, but geez, thank you for volunteering all those good ones. And how cool is that about Mamas, man? I didn't know that. We were talking offline for a second about that. That was so cool. Thanks for saving that when we press record, dude. I appreciate that. So man, that was phenomenal. Aaron, Tyler, you guys want to add anything there, or should I go to next question?
Well, I think John did a great job outlining all these opportunities, and I think they're fantastic. And we touched on a little bit earlier about like the liquidity challenges within this area. And I think this is why kind of for us, as we've kind of taken this maybe boots on the ground approach and turning over rocks, because of the liquidity within the space, this like liquidity is a luxury for microcap companies. We really take a kind of qualitative approach to learning about these businesses. We really look for businesses that I think have like a capacity to suffer, ones that have good long-term opportunities or uses for capital. We look for businesses that have the same ownership mindset that we utilize as we're kind of looking to put capital to work. And we look for businesses that use their balance sheet well, because in this liquidity environment, and because of all these various aspects, you never know where the company's price may go. And we need to be prepared to put capital to work into businesses that we think the long term is misunderstood, and that we are getting at a pretty substantial discount or margin of safety to what we think the long-term value of this business is worth. I think all this kind of encapsulates in that kind of philosophy of looking at these companies and really rolling up your sleeves and doing the work.
100%. That actually kind of dovetails right to my next question, which is basically what that ideal setup looks like for you guys. So when that company ultimately makes its way into the portfolio, what does the ideal Diamond Hill microcap investment look like, both qualitatively and quantitatively?
Yeah, I mean, I think it goes along the lines of the gist of what I just kind of highlighted. Like we look for businesses that have a capacity to suffer, or a moat that endures. Ideally, a company can make themselves better during difficult times. it's wonderful if in the middle of a cyclical downturn, a business is actually consolidating market share or buying out their competitors because they're operating and structured a company that can, really drive through any of those difficult times. Ideally, you have a business that has good long-term opportunities to put capital to work, that they're not playing the quarter-to-quarter game, that they're really looking out to defend their business for, that 5+ year time horizon. And then ideally situations where you want management to be aligned with you. You want there to be high insider ownership. You want them to have the same fate as you do as a passive shareholder in their small company. That also tends to focus the mind a bit in terms of your ability to operate your business, be an astute operator, have good capital allocation. And then the balance sheet, do you have a balance sheet that can support those various elements of putting the capital work? Is your debt supported by tangible assets? Or we've even owned companies that have, a net cash balance sheet, which in our world, I think can be very prudent. So we do an initial kind of quantitative or qualitative assessment of the company. And really is this a business we want to own? We need to be able or feel comfortable. In our portfolio, we own maybe 30 companies ish. We need to feel comfortable that if you're taking up one of those spots, that we want to own you regardless of where the market goes over the next 5-10 years. So we're really handpicking these companies. After we've kind of done that qualitative assessment and said, yes, this is a super interesting company that we're really excited about, potentially owning a stake, we go through the process of actually coming up with what we think it might be worth. We embrace that that's probably a range, but ideally we're buying it at a discount to what we think that long-term intrinsic value is worth. And putting it into the portfolio at an expected return that we think is at least commensurate with whatever the inherent business risk is or assessment of the business risk.
Perfect. All right, real
Yeah,
quick,
and Bobby,
Tyler,
I think you'll find with our three-headed monster that, all three of us work on every single name in the portfolio together when we're vetting the name. And we each have like different inherent biases and behavioral tendencies and cognitive biases. And we like to go down different rabbit holes. So then when we bring all that together, and we don't like to sit in silos too long. So kind of that structure with the three of us allows us to, all right, you're really keen on the board of directors at this company. You're really keen on some esoteric science part of the technology or the addressable market. And you're really into, the financial history and the legacy returns. And we kind of triangulate and all come together, as part of our process, which we think is very effective for us, the way we work. We all have the same overall temperament, but when we get into the nitty gritty, we each work a little differently. And it's great to be able to kind of combine that as our, three heads are better than one approach.
I was going to say, quick follow-up to that is, how do you check yourselves in terms of groupthink? So that, all right, we might all agree, yep, no brainer, okay. But how do you stop yourselves from saying, all right, okay, we may all be there, but are we sure? Who's the one that, the checks and balances part, right? Where it's like, all right, we might be the three-headed monster that are all moving in sync. Does that also include then having that one head or two that are like, all right, let's take a step back here and let's.
That's me. I am the wet blanket of the crowd. For me, it's about risk. It's about managing the risk. And so I tend to, be the thorn in the side of most hypotheses or theses that get brought. And I just want to understand where it could go wrong. And I think going through kind of that possible of a pre-mortem, if you will, of like, if you pre-burn it down, what your worst case scenario is. And then you can understand when I think it gives you the ability to potentially see if a thesis breaks earlier if you've already analyzed where the cracks in the potential investment lie. but it's definitely me.
So it was Aaron that was like, all right, are we sure we want to do this podcast with Bobby right now? Like, I'm not
Aaron's the pessimist. John is the eternal, ever curious optimist. And I kind of sit right in the middle trying to manage the flow.
No, John's the one combing the expert markets, being like, "Oh, dude, there's some great stuff here, man. And, like, there's some good stuff, you know." And hey, there might be. That's it is.
The AI agents do that now.
Oh, yeah, that's true. That is very true. All right, so next up, I want to talk about is then building conviction, and this really has to do with your research process. So walk us through how your team goes from initial idea generation to high conviction in a name.
Yeah, I mean, and I think it's important to step back and realize, like, not all convictions created equal, right? I mean, and so Aaron kind of talked about risk reward. I mean, that's something very important to us. And so we designed our portfolio that way. I mean, we sat down and started this portfolio from scratch, I guess about 6 years ago. And, we knew that we wanted to have differentiated, unique returns. I mean, especially in the institutional landscape. And we were very cognizant of over diversification. Like, we think that's something we don't want. And we definitely don't want to be diluting our best ideas. And none of us like to be involved in like hyperactivity and, hundreds of stocks or anything like that. And so for us, conviction really is the result of our companies earning their way to that position. I mean, we kind of mentioned we generally have about a 30-ish stock portfolio. And you'll see, like, for us, the top 10 positions are in that 50 to 60%. The top 10 positions in the portfolio make up about 50 or 60% of the weighting of the portfolio on average. And the way we kind of construct it, and maybe we'll get into a little more detail on it, but we kind of start with starter positions. And so we use our starting position sizes as a little bit of a risk measure, and it helps us focus the mind. We kind of call it having a lot of irons in the fire. I mean, nothing focuses the mind like owning something. And so we'll start with a small position, and then it'll kind of earn its way up as it goes. And so a lot of the ideas kind of end up small, and the ones that succeed, we're happy to own and build. And it's really, we kind of think of conviction as an extension of our temperament, right? Long-term ownership mindset and being patient. And you're doing a ton of work on every name. Like, you're developing, an entire thesis and going through the modeling exercises, and there's a whole lot that goes into it. But at the end of the day, you can kind of think there are funds that are high conviction funds, and they'll start with 5 or 10% position weights, and they'll only own 10 names or something like that. We're not built that way, right? So that's kind of the way we do it. It's a bit of a graduation, and we found that to be kind of very effective for us so far.
Very cool. John, Aaron, you want to add anything to that?
Yeah, no, that hits it on the head, I think.
Very cool. All right. So a crucial part of this process as well, and doing all that work, is evaluating management. Capital allocation, management alignment can always be huge drivers of outcomes in microcap, smaller companies. What specific traits or behaviors signal to you that a microcap management team is worth backing for the long term? Let's take this one.
Well, it was kind of part of our qualitative assessment a little bit is the ownership mindset for us. So you're not looking to buy a good salesman. You're looking to buy somebody who executes and puts their money where their mouth is. So traits we like to see are, does somebody own a decent stake in this business? Are they, really behind, eating their cooking? What are their actual actions? Like, during a difficult time, what were the decisions that were made? How have they articulated or outlined their decisions? What companies have they maybe acquired in the past? How did they talk about capital deployment in the past? And what are the actual outcomes that have come from that? You look at what board members or what different boards they may be on, or where the different ties of the web lie in terms of their connections. Part of this is we're out, meeting companies. It's understanding and building relationships with different people, and you can then kind of triangulate the types of personality traits that the management team may have. So really, at the end of the day, you're looking for somebody that really looks out on that similar time horizon as us, a 5-10 year time horizon, that has their own personal wealth at risk with the company, that then does a good job of kind of executing on building a resilient business and really is an astute operator within their specific industry. All that stuff is kind of one of those things that I think you build over time as you iterate company by company.
100%. Quick follow up to that, because sometimes, you might, because there's a number of CEOs that listen to this as well. And there might be some you might get a CEO that wasn't the original founder, and they're brought in, like Adam, right? And Adam
Yeah.
comes in. How do you, what are some of the things that are important checkpoints where it's, let's say it's not the founder CEO that is now running the ship and you're now looking at it versus someone that, the board brought in, or, otherwise, a large shareholder brought in to unlock more value?
So yeah, I mean, so something that we've applied, I think, and iterated a few different types of companies has been maybe what I would classify as the change agent, an individual that comes into a business, that they look and maybe has good bones, but something needs to happen that needs to be a little bit different. And a company that we own at this point in time, I think, is a wonderful example of that, called Graham Corp. You know,
Mm.
Graham Corp acquired a business called Barber Nichols, and then they brought Dan in as who ran Barber Nichols in as their CEO, and now he is the chairman of the board. But in that transition, they took a business that was primarily focused on oil and gas and petrochemicals with surface condensers, and other elements that kind of go into the petchem processing. And then they had a small defense business that they were kind of struggling with, but they brought Dan in to, and the entire business makeup changed. Not only did Barber Nichols bring in um, advanced technologies, especially with their turbo machinery, and a kind of plethora of relationships in the defense area that really enhanced that portion of their business and more legitimized Graham into a defense, subcontractor. But he also went to work on changing the culture, um, validating operational structures. I recall conversations with him, and the old Graham Corp didn't have many of their operation procedures actually outlined on how they went about executing on these things, on manufacturing some of their parts. When you're doing a first article contract with a Navy prime, that is your opportunity to document so that you can enhance the margins as that contract gets renewed. Dan knew this. So you look at those elements of a management team operating within a new industry and the decision points that they make on how do they, if you will, fix the house. And then what is their next decision? How do they go about kind of operating and elevating the business to another level? Which I think for Graham Corp has clearly, they ran into a lot of labor issues, which were very short term, but that provided us an opportunity to get a substantial stake in a relatively compelling business. And they worked tirelessly to fix that welding issue that occurred very early on, even hiring temporary welders to fix that issue. And it has solidified their relationship with the Navy that I think has paid significant dividends into the future, and now has put them into a position to go about and find other really bright, intelligent people to come work within Graham Corp, as you've kind of seen with some of the recent acquisitions.
Yeah,
Is
Bobby. I mean, I think it's kind of incumbent on us to kind of find out who has a superior ability to execute and not just put, splashy points and targets on a PowerPoint slide, right?
No, 100%. All right. So, you tell me. I have a couple more on portfolio construction, but I also put together a couple questions regarding structural market insights. I can go either one. You guys tell me, where should I go first? Should I give structural market insights questions or the portfolio construction? You tell me. Where do you want me to go?
I just bang them both, and we'll see
All
what
right,
shakes
okay.
out.
I got one on the structural market side, structural market insight side. So, I mean, kind of addressed a little bit, and that over the last decade, we've seen structural changes in the market, declining sell side coverage, fewer institutional investors able to own smaller companies. I don't know if it's able, it's more just not wanting to, and more capital concentrating in large caps. Do you think microcaps are becoming increasingly orphaned as an asset class? And does that actually expand the opportunity set for long-term investors like Diamond Hill?
Yeah, like my initial reaction to that is our issue is too many opportunities, not too few. That we wanting to run a concentrated portfolio of 25 to 35, and really does focus the mind. And there's a constant email stream between the three of us of things that look interesting, businesses we want to look at, industry trends. So I think there's plenty of plenty of opportunities. So everybody talks about these, the evolving market structure and fewer companies, but at least for us, it doesn't feel like that's impacted the opportunity set.
I think one thing to think about, because of a lot of these structural things you highlight, the risk of value traps increases. So you have to contemplate, how do I get the cash? So a lot of times we're looking for resilient businesses that the long term is misunderstood, but they tend to also be creating value. These are businesses that you would feel comfortable just buying them and taking them out of the market, because you believe that either you're going to get paid a dividend in some form where you're going to get the cash out, or they're going to be worth more, creating more revenue, more operating income, more cash flow into the future. And in time, if you're creating value, it will eventually command investors to pay attention. So, but I think that risk of a cheap stock being a cheap stock, it becomes a lot more prevalent in the current structural environment of small and micro cap investing, as kind of the traditional levers to close the gap to IV are kind of broken at this point.
Yeah.
Oh, sorry, Tyler.
No, I was saying, yeah, I mean, we're doing this in the U.S. I mean, you have the deepest, most dynamic, most liquid capital markets out there. And even in the 5-6 years that we've had this fund, I mean, we've had probably 4 or 5 companies get bought. I think most all of them by other strategic players, maybe one private equity, but mostly kind of strategic acquisitions. And we've had a number of, fortunately, knock on wood, some names we've owned that have kind of gone from that $300 to $500 million market cap into the $3 to $4 billion market caps, and they end up as part of the ETFs and the indices, and more people knowing about them. And so I think that aspect will always be there. I mean, there are going to be companies that graduate to become bigger, more formidable companies. There's going to be fallen angels that come down into this space that kind of, again, could use a change agent or, some fresh perspectives and things like that. So, while some of those, I think the two notions can exist at the same time, at least for the foreseeable future, that we're kind of in this mega cap passive world, but there's a ton to do to generate, unique differentiated returns down here by kind of doing the work and finding these hidden gems or the acorns that can become mighty oaks, as we like to talk about.
That actually dovetails into another follow-up I had regarding just the behavioral investing side of what you guys do. And you've had the fund now or the strategy, excuse me, for the last 5-6 years. What do you guys think has changed from a behavioral investing standpoint that you've caught yourself like, oh, I used to think like that. It did or did not work out. I think I should be now thinking this way when it's either evaluating management, looking at the balance sheet, income statement, all the different things that is part of your due diligence process. Has anything changed from a behavioral perspective?
I mean, for me, definitely don't ignore what initially might look boring. Boring can be beautiful. We've had investment in U.S. Lime and Minerals. We still own, in our small cap fund. It got pretty big on us. from MicroCap land, but I mean, they operate limestone quarries. And at first you're like, limestone quarries, like, but then you start to read, you dig in and you realize that like all the construction in Texas requires soil stabilization, and there's a lot of various, unique end markets that limestone go into. It's hard to replicate these assets, and there's a regional economics in play and pricing power, and you get a fantastic investment return out of it. I mean, another company we love and we own called Oil Dry, and again, on the face of it, like they're vertically integrated. They're a multi-generation family business. It's a fascinating history, and they think long-term and innovate. But if you just look on the surface, the core of their business, they own clay mines and they make a lot of money in lightweight cat litter. They've done a great job innovating there and building this cat litter business. But guess what? When you look at all the other products they've been able to do with this special lightweight clay in these mines that are very hard to replicate, again, agricultural products, fluid purification products, animal health products. They've figured out how the clay can work in the gut biome of animals to help with no antibiotic treatments. I mean, it's an unbelievable company. It's done very well for us. We're thrilled to own companies like US Lime and Oil Dry. I mean, these are the examples that, we really like to point out, because they're, they might seem boring if you're just screening and reading a basic description. But once you dig in, you really have to get under the covers, so to speak. It's fascinating.
It's just such a classic small microcap type companies too, right? Where you just you read the first two sentences and your eyes gloss over for a second. You're like, what? And you know what, that also becomes the opportunity for a lot of folks that are willing to do the work of like, okay, I know for sure reading these first two lines that 95% of investors are going to be like, I have no idea what this is, and I'm whatever, but then that the other 5%, I'm like, all right, great. I know 95% of the people are going to think that this is the most boring thing they've ever heard in their life. Mm-hmm. I'm going to take a deeper dive. So that's a perfect example. So I appreciate that, Todd. John, Aaron, any other behavioral changes even from your perspective too?
Yeah, I mean, I guess the only thing that comes to mind would be, earlier I mentioned that, we came into the space knowing it'd be volatile, and it's more volatile than we thought coming in. And so the ability to, not that we are traders, but to manage position sizing around that volatility, I think is something that I've grown to appreciate more over the years that we've been running the strategy.
I guess to add, I think the behavioral element has been patience.
Yeah.
I think in our small company space, you tend to get a small position size and the price begins moving on you before the fundamentals do. And so then you need to be patient and allow those fundamentals to catch up and allow the company to truly develop what they're, deliver on their plan. And if we were being extremely strict on a buy-sell element, I think you tend to miss out on a lot of the compounding algorithm for small and micro companies.
100%. Okay, you guys actually, Aaron and John, you guys both hit on the next two questions I was going to ask. So I'm going to ask them as a two-parter, and then we'll just have a monster answer as a result. So we're talking about position sizing and risk. How do you guys think about position sizing and risk management while still allowing your best ideas to drive returns? And then part two is about when the thesis breaks. What are some of the signals that tell you that it's time to exit a position because the thesis has broken rather than the market simply just disagreeing with you? So monster answer. Here we go. Let's see.
On the position sizing, I think that's the perfect example of where, especially in microcap land, where investing is more art than science, right? If it was, purely math and a solvable equation, you'd stack rank the names by discount to intrinsic value and build your portfolio, right? But if it was that simple, this would be a heck of a lot easier than it is in reality. So, when you look at these different investments, you have different knowledge levels and conviction levels about the business. The range of potential outcomes for the business can be very wide or very narrow. And then, Aaron has mentioned the balance sheet a couple of times. It could be path dependent, right? If the balance sheet is in a certain situation, all that stuff influences position size. And so, an example of that, we've owned Ondas in the portfolio for several years. It was a business that we really liked, but we always kept the position size smaller because for years the balance sheet was always in a bit of a iffy situation, and that made us a little bit uncomfortable. And then, to tie that into my earlier comments about the flywheel, sort of once they got that flywheel going, the stock started moving, the balance sheet improved, they raised more capital. The balance sheet just kept getting healthier and healthier, and ended up growing into one of the largest positions in the fund. And we sort of sold some along the way, but from a risk management standpoint, the balance sheet wasn't always where we wanted it, so we kept it as a smaller position. I think Tyler touched on some of this, portfolio size, portfolios 25 to 35 companies, 50% plus in the top 10. I'd say from a risk management standpoint, the main guardrail we put in is we have a 10% position limit at cost and 15% absolute. But other than that, we're really kind of go anywhere. And then, kind of smaller, Tyler touched on this too a little bit, but the kind of below average position sizes, it could be something that either we're exiting the position or it's a new position that we're building conviction in. We tend to start our positions on the smaller side. Example, 2 new additions would be MVB Financial we own and Copen. Both we think could have really interesting opportunities, but they're new to the portfolio and we're getting comfortable with the situation. So they may, they're small companies or small position sizes at this point that we think could eventually grow into much larger positions.
Yeah, I mean,
Aaron,
I think there's a couple ways to kind of answer this. I mean, a lot of times people think that price decline is your trigger or some outsized price movement. And when you kind of talk about intrinsic value and the way we kind of think long term and model companies and try to tackle all these issues and triangulate into, people think that you get mechanized or rigid, like it hits this number and you're out, that kind of thing. I mean, in terms of a thesis breaking, I mean, look, again, we've kind of talked about that superior ability to execute and that skin in the game and things like that. And I know your favorite, your capital allocation decisions, but I mean, you want to, do you still like the business? Do you trust management? Do you still believe in the trajectory, of the business? Are the capital allocation decisions still sound? You may like a CEO, he gets fired or whatever happens, and you maybe still like the business, but you're trying to figure out the new CEO. Do you take the position size down? Does the market overreact and you can buy more? I mean, there's a lot of dynamics that occur and everyone's a little bit unique. But generally we like to find situations where, the market overreacts and there's an opportunity for us to be buying more. That's a little bit of a behavioral temperament that we like. But I mean, if we still believe in kind of the long-term ownership mindset and are willing to be patient, those are sometimes where the best opportunities are. We've done that a lot of times. I mean, Honest is an example. I mean, we've been to hell and back on that stock, but John did so much work. I mean, it's an unreal amount of work that he did on that name. Aaron and I felt very comfortable picking at it, keeping supporting the position and letting it play out here.
It's kind of say, yeah, no, that's a good example here in that respect. So, this is probably my favorite question that I love asking everybody on here. And this has to do with lessons from experience. So looking back across your career investing in smaller companies, microcaps, what has been the single biggest lesson or perhaps a mistake that most shaped how you approach microcap investing today? And feel free, you can name a name. You don't have to name a name. It's totally up to you guys. So how about Aaron? I'll go to you first and then we'll work our way.
Yeah, there's a lot of lessons. I think all 3 of us have been here for 15 to 20 years. And before we were running MicroCap, we actually used to run a research opportunities strategy that was a individualized sleeve. So we've got a lot of iterations of putting money to work and whether or not it has played out. And you learn a lot of lessons just trying things. I think one of the things that I think about at times is the best technology doesn't always win. And just because you can see the rational reason why this should work doesn't mean that it will be implemented into a marketplace. A company that we've had a position in is energy recovery. They do pressure exchangers that do have a really great competitive position within desalination of water. And they also have position in wastewater, but they've been recently trying to operate within kind of refrigeration or HVAC systems to help make a more energy efficient process. And what seemed to be an even superior refrigeration product, but there's so many different hurdles in that process for a small company to make a new product work in a new market. Whether it's the gatekeepers, you're also thinking that you're going to displace another parts owner. What's the relationship of those large entities to their parts suppliers, and who are you going to displace? What's the cost associated with actually ramping a product to scale? Is that a good use of capital? How can you solve that capital problem? So I think one of the lessons learned is much more like you can do all the work and it can make total sense, but it doesn't mean that you still get to win.
Yeah, I mean, for me, I'd say, it's worth being mindful of the kind of shiny new toy. I mean, I won't give the name of this stock, but we had a small position, and there was a situation where there was a board member had a big stake, brought in a new CEO. There was a great legacy business with great returns, so there were good bones to the company. They put together a nice acquisition strategy, wanted to transform this thing into a platform and tack on all these pieces, and so get pretty excited about all of it, do all your work on it, and kept it a small position. Like, if they're going to do what they're going to say, like, the position size will take care of itself. We'll let it earn its way, see how it goes. A couple years later, they're divesting pieces, fire that CEO, bring in another CEO. Say, yeah, okay, this didn't work. Like, as much as I may like the core underlying piece of the business and the cash flows there. And fortunately, look, in that situation, we were able to get out even money. I mean, it took a couple years of kind of, opportunity cost loss, so to speak, but like permanent loss of capital really wasn't part of that story, right? So I'd say you got to kind of be careful and mindful of the guys who come in, and sometimes those situations do work. So it is really incumbent on your investment skill, as an investment analyst, a business analyst, to try to figure out. But sometimes you're going to take some shots on goal like that don't work out. And I think that's where our framework around conviction and position sizing helps, because the ones that do work will grow and work, and then you can own them and be patient with them and watch them flourish and become bigger, more formidable companies. And the ones that don't, all right, fine, they didn't become zeros. You were right about the bones of the company. The strategy didn't work. You were able to kind of live to fight another day. So I'd say kind of that'd be one of my lessons there.
Very cool. John?
Yeah, and then I would just add, from kind of a bigger picture, think about how you evolve as an investor through your career. And at least for me, I feel like one of the bigger lessons I learned is you don't get style points for this, right? Like, so the degree of difficulty on the companies you pick, you don't get extra alpha for the harder stuff. And, I think earlier in my career, I was probably too intrigued by like trying to show I could figure out really hard stuff. Where, to go back to, Tyler's earlier comment, sometimes boring could be beautiful. So just because it's easy to understand doesn't mean it can't be a fantastic investment. Like Tyler said, we've had a handful of those that, the business looks pretty simple and have been fantastic investment outcomes. So I think as an investor, for me, evolving over the last, 20 years, it's probably that, like, that you don't need to be too cute with this. Just find good businesses that can compound for long periods of time, durable competitive advantages, good quality management, all that sort of stuff we've discussed.
Absolutely. We'll just waiting for that to go by. And all right. So my final question then for you guys here today is there might be a number of new microcap or folks that are new to the microcap space that are listening in right now. For those that are just entering the space or wanting to find out more information, what habits or frameworks do you think are essential for building a sustainable edge investing in small microcaps?
I'd say first and foremost, for anybody kind of new or looking at it, I mean, you want to first try to figure out, do you want to be a trader or do you want to be an investor? Because I mean, there's room for that. These are huge markets. There's room for that. There's people who are good at both. There's people who are bad at both. but kind of figure out where you want to play and what your niche is. So that would be my first piece of advice for someone new, is figure out, are you a trader or are you an investor? And then you figure out who to follow and which rabbit holes to go down. And clearly we're long-term oriented, patient investors. And so you can kind of, infer from that, I guess.
Yeah, I would dovetail off what Tyler says there, and it's just that be patient and develop your view of investing. I remember in our early days here at Diamond Hill, Chuck Bath, who is kind of one of the patriarchs of the firm, and somebody we all owe a great deal to for all the knowledge he shared over the years. At one point, he was meeting with the research group, and he made just this passing comment, and it's one of those instances in your career where it feels like somebody kind of hit you on the head with a hammer. He said something along the lines of, there are a lot of investment approaches that work. It's sticking to your discipline when it's not working that separates, kind of the good investors from the great investors. And so that always resonated with me. And so, to that new person, it is take that time, be thoughtful about what resonates with you. Like, the three of us have said, value investing sort of clicked with us immediately. So take time to invest in that discipline and refine it over time. Like I said, we've been doing this for 15 or 20 years. You evolve over the time. You're not going to have all the right answers right away. And, Aaron mentioned this too, take shots on goal, try stuff. It's a 20 to 40 year career arc that you're trying to build cumulative knowledge. So be patient.
Aaron,
Yeah,
close this up. There you go.
the same. Yeah, well, I mean, I feel like I'm echoing these guys, but it just shows how much time we spend together. So, I mean, it's all about knowing yourself. So, make as many heirs as you can early on when your nest egg's small. Those mistakes cost a whole lot less than later on in your career. So the whole initial part is just do things, try a bunch of different ways and figure out what fits, what fits within you and your internal kind of ethos, if you will. So once you can figure out yourself, it makes the next step a whole lot easier.
Heck yeah. That is a perfect place to end it on that note. So with that, where can our audience go and find more information about Diamond Hill, the microcap strategy, maybe get in touch with you guys? Where's the best place for folks to go?
Yeah, I mean, so we got our website, the diamond-hill.com. We also have our own kind of microsite, little knowledge hub for small and micro insights from our team here. So, sure we'll paste that link into your into the
Yes.
show notes.
Yes, it will be in the show notes for sure. All right. Well,
and
guys,
happy to talk with anyone. So, yeah.
Absolutely. Well, guys, this was great. Thank you so much for taking the time here today and sharing all of your insights. It was really super fun. Good luck, stay safe, and I look forward to our next conversation and or maybe see you in Vegas. I don't know. We'll see.
Thanks, Bobby. Keep up the good work.
Yeah,
Man.
thank you. Yeah, thanks,
thank you,
Bobby.
guys.
Appreciate you having us.
Thank you.